tuning in to another episode of Retire Right. I am Ryan Wyatt, wealth advisor here in the Pittsburgh office of Wyze Wealth Advisors. Back into the fold is Ron Wyatt, wealth advisor and head of the investment committee, and then Nick Lewandowski, wealth advisor as well, and also co-chair on the investment committee. Gentlemen, it's been a little bit. How are you?
Good, great. Now that I'm co-chair, I didn't know I was co-chair, so hopefully there's a pay increase that comes along with co-chair.
You already had one this year.
The audience was the first to hear it. So
I'm doing well. I'm also doing very well.
Anything new and exciting?
1-year-old slept through the night the other night, pretty much.
There you go.
That's a big win. We're banking.
I noticed that you were a little extra chipper this week. Ron, anything with you?
No, things are going well.
Good. What we're going to talk about today is an investment management concept or strategy that we certainly follow and are big believers in. It's having a disciplined approach to when you purchase investments and when you trim back or sell investments. The kind of like industry standard way of describing that is having a buy low, sell high discipline. We'll get into, we'll explain it from a high level. We'll explain why it's difficult for people to follow this approach. Emotions tend to creep in and cloud judgment. We'll talk about some ways that you can apply this framework pretty easily. More so kind of on the set it and forget it type path. And then we'll also explain some of the more in-depth ways that we are looking at when we should trim back on risk or, purchase securities that might be cheaper compared to historical norms. And then we'll wrap up the episode by focusing on the value that a buy low, sell high strategy can provide somebody. So with that said, Nick, if you could just explain the core concept of what buy low, sell high, really means.
Most people probably get a sense from just looking at the words, right? Mm-hmm. So buy low, you're talking about when prices are down. Mm-hmm. But the key is that in the markets, prices are usually down because there's bad news or negativity in the marketplace. And that's really important to make that connection. The opposite end is on the sell high, you're selling at high prices. But the prices are high because the market is very positive and enthusiastic, optimistic. Nothing can go wrong tends to be the mindset, at a lot of times.
It also just it could not maybe be just like the broad market, but it might be certain sectors within the market or even certain companies.
Yeah, well said. Yeah, it applies at different levels. There's this old Warren Buffett analogy, right? It likens the financial markets to a store. I think the joke is something like when stocks go on sale, it's the only sale that people run away from. That illustrates this concept. And what he's trying to get at with that saying is in every other area of life, like if you go to a clothing store and you want to buy some clothes, you want to get what you want at the lowest price possible. You don't go to the store being like, what's marked up 50%? Right. I want to buy that stuff.
Yeah.
But in markets, because of the way we approach it, we do the opposite of what you want to be doing.
Yeah, I think that's a great analogy. Not many people are going to be flooding into the stores if there's a big sign outside saying, hey, everything here is marked up 50%, right. So it makes sense, but there is definitely a psychological component to it. So, Ron, can you explain why it is so difficult for people to not gravitate towards like the next popular stock that's returning well, or why, on the flip side, when the markets aren't doing well, why it's the initial reaction might be one of like fear or panic instead of looking at it as an opportunity to take advantage of the volatility?
So it's, when things are doing real well, it's the greed sets in, or you can also call it FOMO, which is fear of missing out. Mm-hmm. So you, like Nick said, when the market's high, it tends to be, the news is really good about the economy. People are excited about a certain technology like AI. Mm-hmm. And we start not really thinking about what we're paying for something. We just get caught up in the emotions, and we start comparing to how are we doing compared to the market, compared to our friends, compared to our coworkers, and it just starts becoming a feeding frenzy.
Okay. Is there anything else, any other points that you would want to make on the upside, so like the fear of missing out, or the downside, like the fear of the panic side?
Yeah. So
and with the lens of why it is so hard to do what makes sense from an investing standpoint, but does not make sense from like a raw kind of like emotional standpoint.
Right. So when things are going up, it's relative. We want to have do relatively better, as I kind of insinuated before. But when things are going down, it becomes more absolute, which is we absolutely don't want to lose money, and those don't quite work well together. And so what will happen is our primitive brain is wired to, when we get emotional about losing money in the market, our primitive brain takes over, and it's fight or flight. So a lot of people, you can't fight the market necessarily, so you run away from the market. And people, studies show that a lot of investors sell at very inappropriate times, near the bottoms.
Can you give, you've been doing this for 30 years. Can you give a real life example?
Sure. So unfortunately,
more than one.
Yeah, I've gone through many bear markets.
Yeah.
So the dot-com.
I didn't mean to age you there.
Oh, don't worry about it.
He's been doing this for
I started when I was 15. So.
Yeah, he's been doing this for 75 years.
So during the dot-com bubble was probably the most difficult time in the career for me, because people were getting so carried away, and what was happening just didn't make sense. So, for example, there was something back then, and now we have the Magnificent Seven. Back then, we had the Four Horsemen. Mm-hmm. So those companies were Cisco, Dell, Intel, and Microsoft. Mm-hmm. And if you think about it, for online, you needed to have the pipeline. That was Cisco. You needed computers, Dell. You needed chips in the computer, Intel. And not everything was done online, so you needed some software, Microsoft. Mm-hmm. So those companies did really, really well, got very expensive. Cisco went up so much, it was 3,700% in a 5-year period of time, ending at the peak of the dot-com bubble, which was early 2000. NVIDIA hasn't even gone up that much recently. Mm-hmm. Cisco was so expensive, it was trading well over 100 times earnings. And when I say earnings, it's what you pay for Cisco, the price, compared to what you're getting, which is the earnings, right?
Right.
Price to earnings ratio.
I think like what would happen there, tying it back to the fear of missing out and the fear of panic, is say somebody held Cisco during that time. What's going to go through their head is, I'm not going to part ways with Cisco. Look what it's done. But then on the flip side, when it goes down, you're going to want to jump ship. I mean, it's like that. It's going to be the complete opposite set of emotions that you had when it was doing well.
Right.
And so that's kind of what we're talking about here. Again, from the psychological standpoint, is the emotions are natural. They're gonna come in first, but there's more of a disciplined, repeatable process that focuses on taking the emotions out of it, which we're going to highlight some of the different things that you can do. So
right. Let me just, I wanted to add something too about the aftermath of the dot-com bubble. So I mentioned the Four Horsemen. Mm-hmm. If you look from the peak till now, about 25 years later, not only Microsoft has outperformed the market, the other three did not.
Okay.
And it took Microsoft until about 2016 before it was actually higher than the price that it was back in 2000.
So Microsoft wasn't immune to the tech bubble bursting.
It fell 60%.
Which is more than the S&P 500 as a whole fell
during
the global financial crisis, 07 to 09.
Right. So not a lot of people would have the ability, the mental fortitude to say, hey, Microsoft, we don't have a crystal ball. Microsoft's going to be a great company long term. So yeah, it might underperform for 16 years and it fell 60%, but I know it's going to do well.
Right.
Most people would probably sell and not have the patience to stick with it that long.
Yeah. So I briefly mentioned like having a disciplined, repeatable process, focusing on taking the emotion out of it. Nick, I'm going to kick it over to you. Can you focus on a couple things that people can do to buy low in a disciplined way?
Easiest thing on the buy side that anyone can do, literally anyone, and you're probably doing it already if you're listening to this or have done it already, dollar cost averaging. Think of your retirement plan contributions that most of you made while you're working. You set it and they just happen automatically every time that you're paid or whatever you set. And then you never think about it again. So there is no hemming and hawing over the timing. There is no primitive brain attack at any point in time. You will buy some when times are good, but more importantly than that, you will also buy plenty when times are bad. And so, you average out the high buys and the low buys, and it helps improve your returns over time.
When you're buying at a low, you're accumulating, that dollar amount that you're putting into the 401k, it's set, right? And so that money is being spread out across all the different investments in your 401k. When the markets are down, that money you're getting more bang for your buck, essentially. You're accumulating more shares when they're down. And so when the markets do recover, you're going to be better off because of that.
That's correct.
What about on more of like the, not as simple dollar cost averaging kind of technical side of things?
So the professional or the pro-am, addition to this is looking for quote value.
Okay.
And that means you're digging a little bit deeper and you're trying to understand based on some of the statistical measures that Ron's talking about and all that data, what looks like a particularly good deal in the stock market store at this point in time? Where am I getting that shirt or hat or whatever at a great discount relative to the quality of that item? Takes a little more time, a little more energy, a little more study is required, but it can be very effective when implemented properly.
Now, Ron, coming back to you, so the flip side is, not buying, but selling. So how do you sell when things are, high or expensive in a disciplined way?
So there's something called rebalancing. And rebalancing is simply this. Let's just say that you're in the late 90s and you're 100% in stocks. You're younger, you have 100% in stocks. So you should set up a well-diversified portfolio that would include mostly U.S. large companies, maybe both growth and value, small companies, international. And the logic is once you have that allocation set, as the tech stocks are running, the U.S. large companies were running, they're in your portfolio, they're getting overextended, right? They're getting way above your target allocation for them. So what you do is simply trim those down to buy it in other areas that have basically been lagging basically on a relative basis, getting cheaper. So you're putting money maybe into small, maybe into more value-oriented companies, maybe towards international. And when you did that, you'd have been trimming before the market fell, and March of 2000 was the peak. And then after things fell, the NASDAQ fell like 60% afterwards, then you could take some of those positions that have been running and buy back into it. So that's just what rebalancing is. You're trimming high over time and you're adding low.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
We could do, and we will, do an entire episode on rebalancing, but if you could just make one point or maybe further explain something on the rebalancing side. Why is it so important to, when looking at rebalancing, also, be able to determine when it's logical to make a change. It's, in other words, you don't just have like a set parameter that's saying, hey, if a certain asset class gets 5% away from its target allocation, that's when you make a change. Why do you make changes when it's more impactful, not just a set line, set rule, and make the trades then?
So as Ryan said, I've been in this business for a few years, and I've seen firms work for firms that might only rebalance like once a year. And so let's just say that you have a certain asset class and you want to have 10% of your money in that. If after 1 year you don't have 10%, you have 10.2%, should you really trade it? Mm-hmm. Does it have any impact on the portfolio? And the answer is no. So what we do, my belief is you look often and only trade when it has an impact. And so what I mean by that is that if you have this target of 10, then it has to go outside the bands. Maybe, if it goes over 12% or under 8%, you do something, right? If it goes over 12%, that means it's been running, getting expensive, you trim it. If it's below target, at 8%, it's getting cheaper, you add to it over time.
Gotcha.
Yeah.
I know we talked about rebalancing a decent bit there. There is one more point that we wanted to make on the selling high, with a plan, or selling high in a disciplined way. Can you talk about how, what your thoughts are when somebody is transitioning from working to retirement?
So the example I used earlier was about a pure stock portfolio, but for most of our clients, they'll have balanced portfolios of stocks and bonds. And so, and it works very well reducing risk in a balanced portfolio, very, very well. But when you get close to retirement, what you don't want to have happen is, say that you plan on retiring in 2000 or 2001, and you're so excited in the late 90s you have a 100% stock portfolio, especially high octane NASDAQ tech companies. So you may have had $1 million, and then after the bear market, maybe you're down to below 500,000. Your retirement plans probably have changed. And so prior to retirement, you definitely want to get your portfolio transitioned. So if there happens to be a bear market, right before you retire, that you're well positioned for it.
Yep. And it's actually interesting, but in just plugging another episode that we'll be doing in the future, but there's this thing called sequence of returns risk, which basically, shows that the most important time to avoid, and nobody can truly avoid it, but you can control it a little bit by having a good allocation. The most important time to lower your risk on the investment side is actually at the initial stages of retirement. And like I said, we'll do an episode on that in the future, but the results or the impact of having some poor returns early in retirement
Can be
it's surprising.
Devastating.
When you look at the
Can be
numbers, it's
devastating,
really
right.
surprising.
Yeah, and there's multiple ways, and I'm not going to get into it, but there's multiple ways. One way, you just kind of shift the risk down as you get closer and closer to retirement. The other way is maybe 4 or 5 years before retirement. If you're in a really good bull market, you do it then. So there's multiple ways of doing it, but it needs to be done.
Nick, I'm going to let you bring us home here. We've set the foundation. Mm-hmm. Let's talk about the value that having a buy low, sell high discipline, can afford somebody, or the value that it brings by having a buy low, sell high discipline.
This whole area of when to buy, when to sell is an area where perfect is the enemy of good,
Mm-hmm.
truly. So much emphasis, especially in financial media, is on timing it perfectly, making the right moves at the right time, because that's what gets the eyeballs. Mm-hmm. That's what appeals to the primal lizard human brain that is greedy and fearful.
I take offense to that.
Right. That's what gets the clicks, so to speak. So what we're trying to do here is not be perfect. What we're trying to do is actually develop a new way of acting and thinking that pushes back against the lizard brain, primal brain, and all the bad things that it causes us to do financially. So that's that's the real value on the underlying level that you're creating. Is you're giving yourself like this alternative framework to make better decisions, as opposed to get better results, at least if you're automating it, than relying on that primitive part of you and your reaction to things.
And something that comes to my mind here is, because this all sounds great, right? But we see it firsthand. People will get very nervous, especially when they're retired, they're no longer working, they have their portfolio and they're dependent on it. It doesn't really matter what's happening in the markets. When there's volatility, people get nervous. I think the old school and frankly just bad advice way is saying, hey, ride it out, the markets will recover. What do we do internally to kind of educate people on the trade-offs? Like, in a way, like entertain the idea and show them, hey, if you do this, this is the result and this is how it impacts you.
I love Ron's approach to this. So Ron, you want to talk about
it? My approach was through some scars I had earlier in my career. So back in the tech bubble, when things were going down, fortunately, I was positioned pretty well. But still, accounts went down.
Yeah, you're still going to experience market losses.
And so people were wondering, do I get out? And back in that time when I was newer in the profession, I would say, hey, stocks are going to come back. Don't worry about it. Keep with the plan. And basically, this kind of went in one ear and out the other.
Yeah.
And so I listened, but I really didn't listen.
Right.
And so as we were equipped with more and more planning tools, and as I evolved to not just investments, but to planning as well, during the 2007 to 2009, global financial crisis, people had a lot of concerns, and they should have. It was bad. The market went down like 60%, the stock market. And so what I did then, if people were concerned and thought about getting out, is I would say, well, let's get together and talk about it. Let me show you, if we change your allocation, how does this impact you? So now, instead of this thinking emotionally with that lizard brain that Nick was talking about, now they can say, hey, okay, if we make these moves to reduce risk so we can sleep at night, what's our retirement future look like? And I found out that most people decided not to change. Few people did, but the changes were not significant. It gave them the feeling that they were now in control, and they were able to ride the rest of that bear market out. And of course, we were doing the rebalancing. So as the market went down, we were taking from the assets going up, like the bonds, and buying stocks low. So it worked out very well.
Yeah, it's all about, one, you're actually, with that approach, listening, not just regurgitating concepts and principles that you believe in, but looking at it from their perspective, seeing how they feel, and showing them what their options are. And when you show them what their options are in a retirement plan, it's very clear what the trade-offs become, and then it just becomes a more collaborative kind of conversation there.
And one I just wanted to mention one other thing, because we've been talking a lot about rebalancing and buying low, trimming high, but also it's on the security level too. With our any portfolio we run, it could be with exchange traded funds or stocks. Not only is it, what we're looking for is to try to, in general, be cheaper than the market, and at the same time have the similar type of quality, similar type of profitability. That equation works well over the long haul. That's kind of like the Warren Buffett way of doing it. So it's on the big picture, different asset classes like U.S. large and small companies and U.S. versus non-U.S. But it's also on the security selection part of it too. So there's two levels.
I think that's a good segue. The last point that I want to finish up with is what this approach can do from a return and risk standpoint. So Nick, if you could talk a little bit about that.
It ends up being really simple because it does what everyone wants ultimately, which is by accumulating more assets that will return in the future at lower prices, like we talked about earlier and you summarized, your return should be higher over time than if you weren't doing that. And on the risk side, it works similarly. You are making sure that things stay in balance so that When you have different asset classes, for example, like bonds and stocks, like they're in the right proportion and they stay in the right proportion over time. And it also makes sure that your portfolio doesn't start to, as things go up and up and up and up and up in price and potentially become a worse and worse and worse deal, it makes sure that you don't own too much of that stuff.
Yep.
It absolutely helps with risk. I mean, risk is incredibly good, and for more equity portfolios, it can help substantially with returns as well.
Yeah. Well, gentlemen, I appreciate you guys taking a deep dive on this concept with me. And for the people listening, clients, you have questions per usual, reach out to us. We're happy to, like Ron and Nick talk about, show you what your options are, especially when volatility enters the marketplace. Also, if you like the show, subscribe, please. And we've had some great questions come in from clients that we've, made podcast episodes on already. So please continue to do that. This is all focused around, continuing education for our clients. So if you guys give us the topics, we will make an episode off of that. So we appreciate you tuning in. Thank you.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.